everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about return on capital. So if you missed yesterday's segment, we talked about probability of profit, which is essentially the probability of your trade reaching at least 1 penny of profit. So if you missed that one, definitely check it out by clicking Find Shows at the top. Go down to Mike and his whiteboard and it'll be the last one listed there. But today we're going to talk about return on capital and the relationship between return on capital and yesterday's segment, probability of profit. So let's get right into it with return on capital. So when we're talking about return on capital, essentially what we're looking at, as you can see here, is max profit over capital used. So we're basically taking a look at the maximum amount of money we can possibly make on the trade, and we're dividing that value by the buying power reduction or capital used to place that trade. So let's walk through a few examples here. So if we're looking at a naked put, let's say I'm selling a naked put that's a few strikes out of the money. Let's say I'm collecting a $2 credit for that, and my buying power reduction is $1,000 to place that trade. So knowing this buying power reduction is pretty low, I can pretty much assume that this would probably be something that would be done in a margin account. And my return on capital is pretty high up there. So 20% for selling one naked put with a buying power reduction of $1,000. So basically I'm just taking that $2 credit, which is really $200 because an option contract gives you the theoretical right to control 100 shares of stock. So we take that $2, multiply it by 100 to give us $200 divided by 1,000, which gives us that 20% value of return on capital. Now we can take a look at a totally separate trade. So let's say we're not going into naked options. Let's say we're defining our risk now. So we're going to look at a call credit spread, and we're collecting 50 cents of credit on this trade. So let's say it's a $2 wide spread, and we're not taking the credit into account. Let's just say we're looking at the full $2. So our buying power reduction is $200, and that gives us a return on capital of 25%. So the first thing comes to mind when we're looking at call credit spreads, which is defined risk, versus a naked option, which is undefined risk. The first thing that I like to see is that the return on capital is going to be a little higher generally with defined risk. And that's because with defined risk, we can lower our buying power reduction and still collect a fair amount, but that lowering the buying power reduction is really what's going to increase our return on capital. However, when we do that, we're going to be lowering our probability of profit, which is what we're going to get into on the next slide when we're comparing the difference between return on capital and probability of profit. So let's get right into the next slide and we'll discuss that a little further. So when we're looking at return on capital and probability of profit, there is a relationship. And the general relationship is that when I'm increasing my return on capital, I can generally expect my probability of profit to go down. So if we look at this first image here, when return on capital widens or increases, you can see that the probability of profit gets more narrow and more narrow. So essentially, the higher my return on capital is, generally the lower the probability of profit will be. Now, if we flip this on its head, if I am reducing my return on capital, generally that means I'm increasing my probability of profit. So let's think about this for a couple of examples. So we'll talk about that naked put scenario. Now, let's say I'm selling that naked put and I'm selling it very, very far out of the money. Now, it's probably going to look something like this. So instead of collecting $2, maybe I'm only collecting 30 or 40 cents, but my buying power reduction is still pretty high. So when I take that 30 or 40 cents and divide it by that high buying power, my return on capital is going to be lower, but since my strike is much further out of the money, it's going to have a higher probability of profit. And let's say we take that trade and we move it at the money. So let's say I'm increasing my return on capital. So now I've got a trade where I'm selling a naked option right at the money. So I'm collecting a lot more than that $2 value. Let's say I'm collecting $3 or $4 now. So I'm taking that value, dividing it by the buying power reduction, and it's going to give me a higher percentage because I'm collecting more and it's pretty much using the same buying power reduction. So with that said, I'm going to have a higher return on capital, but since I'm selling the at the money strike as opposed to a very far out of the money strike, my probability of profit is going to be lower. So that was an example of a naked option. Now let's talk through an example of a defined risk option. So let's say I'm looking at that same at the money option, but instead of having undefined risk, I purchase an option that's out of the money to define my risk. So what I'm effectively doing is I'm reducing my credit that I'm taking in, but I'm also reducing my buying power reduction. And generally when I do that, I should see the higher return on capital. But since I'm collecting a lower credit, my break-even price is going to be more narrow than if I were to have just sold that option naked, which is what gives me the higher return on capital but a lower probability of profit, which is generally what we see when we compare selling a naked option to selling that naked option and defining the risk. Generally, we're going to see that higher return on capital but a lower probability of profit. So let's go to the next slide here and we'll discuss return on capital a little bit further. So the big question here, how do we increase our return on capital? The first thing we can do is look for high IV environments. So let's say I'm in a margin account or an IRA account. Doesn't really matter. It's just going to depend on the buying power reduction that's being used to calculate that return on capital. So let's say I'm in an account and I'm looking for a trade. Let's say I'm looking at a $50 stock and I'm looking to sell the at-the-money option of $50. So the difference is, in a low volatility environment, selling that option is going to be a lower value than if I'm at a higher volatility environment. So what we talked about in previous whiteboards is option prices drive implied volatility. So if option prices are higher, that must mean that implied volatility is higher, which means that I can sell the option in a high implied volatility environment for more than I could sell the option in a low volatility environment. And that difference is going to be that difference in return on capital. So if I'm selling an option for $2.50 at the money in a high implied volatility environment, that very same option and that very same expiration in a low volatility environment might only be worth $1.50 or $2. So using that same or relatively same buying power reduction but collecting less is going to reduce my return on capital. So what we like to do is look for high IV environments where we can sell the premium against that same buying power reduction to give us a higher return on capital. Because at the end of the day, return on capital is just max profit over capital used. And when we're selling options, the max profit is essentially just the credit we receive. Another thing we can do, which is especially efficient in an IRA account, is define our risk. So the difference between an IRA account and a margin account is simply the buying power reduction and also some rules that we can talk about a little later. But for an IRA account, we're not going to get that additional margin. So we talked about buying power reduction, and with a margin account, it's generally going to be right around the 20% mark of the underlying value. So if I'm looking at an at-the-money option, the buying power reduction in a margin account could be right around that 20% value. So if I'm looking at a $50 stock and I'm looking at selling the at-the-money put, it might be right around $1,000 for buying power reduction in a margin account. But when I compare that to an IRA account, which is going to secure that full cash value, it's going to be around $5,000. So there's a big difference between buying power reduction, and therefore it's a big difference in return on capital. But one thing we can do in an IRA account is define our risk. So instead of selling that naked option and absorbing that entire $5,000 of buying power reduction, what I might like to do is define my risk. So when I define my risk, like we talked about before, I do collect a little bit less, but I do define my risk and I reduce that buying power reduction that's required to place the trade. And in doing that, I'm increasing my return on capital and decreasing my probability of profit a little bit. But it is something that we can do in an IRA account to be more efficient. So let's get to some takeaways on return on capital. So return on capital is essentially max profit over capital required. So when we're selling options, it's really simple to figure out this metric. We're just looking at the credit that we're receiving, which is essentially the max profit on that trade if we're selling an option, and just dividing it by the capital used. So it's going to differ in different accounts, so it's important to notice that. And also, return on capital has an inverse relationship with probability of profit. So like we talked about, if we're looking at buying power reduction and increasing that return on capital with an undefined risk trade, if I'm moving the strike closer to at the money, my probability of profit is going to be a little bit lower, but I'm going to be paid more for selling that at the money option than I would be for selling a very far out of the money option, which is going to increase my return on capital and reduce my probability of profit. And on the flip side, if I want to increase my probability of profit but reduce my return on capital, what I can do is take that at the money option and just move it further out of the money, collect less, but give myself a higher probability of being correct. And last but not least, return on capital will vary depending on account type, margin, IV, etc. So there's a lot of different variables that go into it, but in general, the biggest one is going to be account type, and that's going to vary between IRA accounts, margin accounts, portfolio margin accounts, cash accounts. So it really just boils down to what account we have, and it's important to understand what that is and just look at the buying power reduction of each trade so we can easily calculate the return on capital of those trades. So this has been Return on Capital. Hopefully you guys enjoyed it. Thanks so much for tuning in. We're actually going to be off tomorrow. Dylan Radigan will be in the house, so we'll be back on Tuesday. So have a great weekend, everyone. And if you've got any questions, shoot it over to support@dough.com, or you can tweet us at @DoughTrading, @DoughTraderMike, or at. Have a great night.
Hey everyone, thanks for watching our video.
If you like this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.